Okay, welcome everyone. Good morning. We'll start our lesson 3. Today lesson will go through our LO3. Until now we cover LO1. We discuss about what is the accounting, what is the management accounting. We discuss about qualities of financial statements, and we discuss about how many types of financial statement we prepare in accounts. So we had a discussion about what is the difference between management accounting and financial accounting. Then we said internal, external, and we discussed about accounting principle, accrual basis. We discuss about various other types of accounting, project accounting, and cost accounting. What are the purposes? Why we in accounts we prepare these accounts. And what they use it. And we discuss about stakeholders. Anyone who has any interest in the business, those are the stakeholders, are the user of the financial statement. Today lesson will go through the interpret financial statement, and will go through and we'll discuss financial ratios. Interpretation is very important. What these figures meant by to you, and how we can use various stakeholders, various uh, shareholders, and the employees. Those are all the stakeholders. Yes? Okay, we'll start. LO3 interpret financial statement. Okay, calculate the financial ratios from the set of final account. Compare the performance and organization over time using financial ratios. We can compare the ratios from like 2022, 2023. So we can see what's happened in terms of revenue. It's increase, it decrease. We can look around what's happened net profit, gross profit margin. So we can look around the four types of ratio: profitability, liquidity, use of resources, and gearing ratio, which I will go through and I'll explain you. Okay, so calculate and present financial ratios from the set of accounts. Okay. The objective of the financial statement are to enable user to make economic decisions. Like if you're an investor, you can look around the financial statement. You can calculate these ratios. The last year profit was, let's say, 60%, and this year is a 40%. So, which is a 20% drop in the profit. So this is indication that the company performance is low. Then we can look around the economic situation in the country. Is it due to the credit crunch that the company not perform well? If everything was normal, what are the reason behind it? 20% drop, that's a significant. And if carry on dropping next year 20% and next year 20%, means company not earn the profit, and how we can cover our loan back. So that's these are the question mark for us to look around and ask ourselves before authorizing the credit as a like a bank, like a suppliers, if you're giving credit to. Okay, so ratio analysis is a technique that uh, can be used to interpret the financial information. Ratio analysis involves assessment of the financial statement, comparing one figure against another, and produce the ratios and assess where the indicates weaknesses are the set trend in the company's affair, like uh, in the profitability, in the asset, in the liabilities, what's happened. So these will go through. Okay, ratio analysis assess the performance and the position and the prospect of the company. That's which we'll go through and we'll discuss. Ratio analysis enable identification of the positive and the negative trend, as well as the potential problem. Allow comparison of the financial performance of similar businesses in the same industry. Should be conducted regular to form the basis for planning for successful growth of business in future. That's is a crucial, which we'll go through. Advantages of ratio analysis: it makes figures easy to understand. It's allow comparison regardless the size and the currency. It is a quick and relatively simple means of assessing the company health, business health, and one can build up the broad pictures of the business on the basis of the few key ratios. Any question, please? If you have, you can ask. Okay, so we'll go through the limitation of ratio. The ratio, maybe ratio is the number dividing one number with other number, like asset and liability. Uh, Sometimes ratios not give the true and fair indications because there are a lot of fake figures. Sometimes company use the creative accounting under and never state the figures. So that's why we have some other economic factor we need to look around, not just rely on the ratios. Certain ratios, like before COVID, ratios were good. Then the COVID happened, and the COVID, the business is closing. We don't rely just on the ratios. We look what economics, environment, political, economic, social, and technological alternative methods and the answers we can look around. They can highlight the problem but don't suggest the solution. These are the based on the historical data, what's happened in the past. Okay, so we can look around the ratios, profitability ratios, return on capital employed, return on equity, gross profit, and net profit margin. These ratios we can use under the profitability. Then you have a liquidity ratio, current asset divided by current liabilities. So these we can look around current ratios, asset test ratios, cash ratios, and net working capital. Yes, that's the running capital. And the efficiency ratios are use of resources, assets, account receivable, how many days we are receiving money from our credit customer, how many days we are paying to our suppliers, how many days the asset is converted into the finished goods and we are generating money from the asset, inventory turnover, how many days stock we are converting into finished goods. Leverage ratios also, we can say gearing ratio, we can look around capital gearing, debt versus equity, interest cover, how much interest, finance cost, again, money we borrow from, debt to equity ratios and asset to equity ratio. These are all the ratios we look. Profitability ratio. So please, what we do, I'll give you the separate formula sheet we can use. Other formulas given in these slides as well. You can pick, few, we can use them. Gross profit divided by revenue times by 100. So we can find it margin. Net profit divided by shareholder equity. Equity means the share capital, is mean investment, it means share, the value of the shares. Okay, net profit divided by revenue. Revenue is mean turnover, sales. Okay, return on capital employed, earning before interest and tax divided by the total capital employed. Employed means total capital, total worth of the asset you have in the business. Any question? Please, if any question, you can stop me and ask.
Uh, what is revenue?
Revenue and the sales is the same thing. Revenue also known as a turnover. We say this company have a turnover, this company have a sale during year, like 2023, how much worth of the sale. Three words will carry on using: revenue, sales, and turnover. These are the same thing, no difference. Okay. So
Okay.
we can use the word revenue, we can use the word sales, and we can use the word turnover. So no difference. It's the same thing. Because
And
different countries, some use revenue, some say turnover, some use sales, which is all sales. Yeah, it can be credit sales, it can be cash sales.
shareholders equity?
Okay, shareholder. So shares mean is a small proportion of the investment. When we say share, is a proportion. Equity means shares capital, like in the company, public limited company, we issue shares to the public. And how many worth? Let's say 10 million worth of the shares we issue. So this is called shareholder equity. Equity means how much investment they have. This is mean the capital in the company, or we call investment, or we can call capital. So if it's not a company, if it's a sole trader, partnership business, we call capital. In the company, we call equity. That's the key difference.
Okay.
Yeah.
And total capital employed?
Okay. Total capital means total worth of the asset of the company. Always our total asset is equal to total net asset is equal to total equity. It's mean total capital. Yes, equity and capital implied is the same thing. Total, which is mean everything is included. The revalue of the shares, the value of the shares carry on changing in stock exchange. So we can say total capital implied mean total worth of the asset. Asset always equal to capital. Like your house is an asset, and how much money you paid to bank to buy a house, that's your capital, that's your equity. Yes. So if
Okay.
your house is 100,000 and you paid 50,000, so your total equity in the house is a 50, and less your 50 is your liability. So 100 minus 50 liability, what is your net asset is a 50,000. So it's 50,000 your capital implied. Implied mean used, yes? Is okay?
Yeah.
Okay, great. So we can look around. Then we have asset. Current asset means short-term asset. Asset mean anything you own, anything has the value is your asset. So current asset, the asset which carry on changing its value within 12 months, such as cash, such as receivable, inventories, prepaid. These are all your current assets. Then we have a current liability, the liability which we need to pay off within 12 months, like overdraft, like account payables. Account payables mean if you buy things from suppliers on credit, that's known as account payable. So we'll say current asset divided by current liability. Any question? Okay. Cash,
No.
cash plus market securities, which is mean, securities also mean shares divided by current liabilities. Okay, then we can look around the quick ratios. Quick mean most liquid. Sometime is the inventory. When we say liquid, it means anything which can be converted into cash quick. That's known as liquid. Cash itself and anything else which can be like if you have to receive money from someone, it's a legal agreement. You give to the bank, you can collect the money from the bank, 80% of that at least. 60% depends your reputation as a company. Okay, current asset minus inventory, because inventory sometime if you have window 98 CDs, maybe no one is buying and you're saying is my asset, my inventory, my stock, maybe outdated. So sometimes we take out the stock and we look, which one is the most liquid after taking out inventory. Current asset divided by current liability. Current asset minus current liability is known as working capital. Is mean running capital, how much we have a capital in the business in the short run. Okay, if you have a question, you can ask, and then we'll move to the next section.
No
Efficiency
question.
ratio. Efficiency, it means how quickly you converting things. Like if you're selling things on the credit, how quick you receiving money from your customer. So we can say net credit sale, how much sales you are doing on credit. Net mean you're selling things, sometimes people return it. What net you have? So taking out the return. Average account receivable, average how many days you're receiving the money. Yes, at the start, at the end of the year, how much receivable you have, you divided by 2, you can say average net credit sale divided by account receivable. I'll give you a formula as well, separate sheet. Uh, Net credit purchase divided by account payable. We can find the turnover. We can find in how many days. So how many days we are receiving money. We can do 2, 3 formulas. We can use it, whichever you use, no problem. Cost of sale, goods sold, how much cost you and how much is the average inventory. Opening and closing divided by 2, which mean average mean. Okay, net sales divided by average total assets, and we can find the percentage and the ratios of this year and the previous. Okay, then we have a gearing. Like if you drive in a high gear, is a high risk. If you have a lot of loans from the companies, is a high debt. So we can say equity in shares divided by how much is basically how much is the debt you have. I just use the word different. Okay, so how much the debt you have, which we can say this is debt to equity ratio or equity to debt. So we can find the ratio. Other formula is also debt to equity ratio, total debt divided by total shares. Okay, then we have earning before interest and tax, interest cover ratio divided by the interest cost. So we can see if you're a lender, if you're a bank, if the profit is only 2 times higher than the interest cost, so you can decide which rate you will offer to the companies. Okay, total equity divided by total asset, so we can find the ratios between asset and RA. So we can calculate these ratios from the set of accounts. Ratio analysis, we can go through the ratios from the test scores, profitability, liquidity, efficiencies, and you can choose any company of your choice. All the ratios always available, even online, we can pick it. So if we look 3-year ratios here, gross profit divided by revenue. So what's happened in 2022, there was the ratio 7.1. In 2021, it's 6.5, and then is a 7.6. So which year is the best when the company performed better? So 2021 to 2022 is an increase there in a profit. So we can say 7.6 minus 6.5, how much is the increase? Yes, that's the way we can interpret the ratio. Does it make sense? Yes,
Yes.
we can say the company performed better in the years because the ratio has increased or improved. Yeah. But between 20 and 21, the ratio is decreased, yes, which is not a good sign for the business. Okay, return on equity, that was 7.3, 4.4, and then 9 points. So is 2022 better than 2021? Return on capital employed. So we can each ratio, we can look the figures and we can interpret these in our own. And when we writing, we can say, looking the net profit is being increased. What happened in 3 years? We do the comparison, and we can say this year was better than. Then we look the liquidity ratios after the profitability, current asset divided by current liability, like current this. So these are 0.3, 0.73. It means every 1 pound of asset, every 1 pound of liability, there were only 0.73. It means 73 pence were asset. So asset was less, liability were more. What's happened in next year? It's been further drop. And in 2022 is increased, improved, is a better. Yes. So, but still is less than 1. So this still is a company, is a risk, but the risk is reduced. Quick ratios, as we said, most liquid, its look is decrease and then increase. Cash ratios, cash position, what's happened is decrease. That's not a good sign for the company. So cash is decreasing. So that's cash is a lifeblood for any business. Without cash, maybe that company can struggle because the ratios is not good. It dropped from 0.02% to 0.16 and 0.15. Yeah. And then we can look around tradable, receivable days, turnover days, those we can find in days and points. So account receivable turnover in 8.8 days, we are receiving money. 8 days we are receiving money, and 7.5 days we are receiving money in 2022. Yes, but we paying money in 60 days. So difference between receive money from customer and pay to supplier. So we receiving in 8 days, 9 days, you can round it. And this we are paying in 60 days. So the difference is 52 days approximate. That is our, we always have a cash in our accounts, yes. 57 days, and this is the days is drop. That's not a good sign, but here is also days drop. We're receiving quicker, which is good sign. Okay, inventory turnover, how quick inventory we are doing in finished goods. So we can find 15, 16 days. This was 33 days. So we can compare these and we can say how quickly we converting asset into the finished goods and we generating profit by using the formulas. Of course, these are the graphs prepared and that's, which we use it. Okay, then we have a capital gearing ratios 1.62, 1.66, 2.1. So we can high gear, high risk. If you have these ratios increase, so sometimes the debt to gearing ratio, you will see that's 62% debt, that's 60, that's 47. So this year was better because there's a decrease compared to other years. asset to equity. So how much asset and equity, that's you will see there is a improved there, which is good. Interest coverage ratios, which is improved. That's a good sign for the business, and the risk of the company is reducing. So these, the ratios we can, and that's which we have. And the next lesson we look, the further overall performance in the light of balanced scorecard models and other. And today lesson, we look around the intertrade financial ratio. I can give you separate formula sheet as well. Okay, so I can share with you in a minute, and that will also help you. Yes, when you're using the formula. So if you give me 1 minute, I'll share with you. Okay, just 1 second, I'll share with you. Okay, I shared with you now. Okay, you can download from the chat box if you want to. So these are all the ratios. Hope you can see it. Yes. So you don't need a lot of formulas, but you can use uh, two at least each category. This profitability ratio. So we can pick it gross profit and net operating profit. Gross profit divided by revenue and operating profit divided by revenue. Yes. Then you can do liquidity current asset divided by current liabilities, quick ratios. So you can pick two, and then you can go through trade receivable and total receivable divided by revenue times by 365. The figures we can find from the balance sheet, and we can look around these from income statement, balance sheet, the figures, and we can divide it simple. We can calculate the ratios and the gearing and all this. So these are the four categories of ratios. We can do at least two up from each. Any question? Yes, yes,
No,
no, no. Okay. So we'll keep up to here. If you have any question, you can drop me email and keep it to next lesson. And the next lesson will go to our LO 4. Thanks for attending and have a lovely weekend. And speak to you tomorrow then. Thank you.
thank you. Bye.
Thank you. Bye-bye.